An AI enhanced DCF model. There's something which is called as complexity, and there is something which is called as black box. These are two important parameters which we need to pick up. And various implementation, various industries, how do we do it? What are the advantages? What are the challenges? And where we could use AI in a ready-made fashion. That also I will come back to you. And there are certain, of course, challenges which are going to be faced. You can't just throw something in the hot water and say, was I need to boil. It depends on what ingredients you put in. That is the way it works out. Let's talk about little on the introduction. When we combine, I'm going very slow in this presentation. The reason is this, whichever slide I want to discuss, I want to make it important for an RV to understand and achieve a value addition rather than just running into tons of slides which I have where various industries. It's a huge presentation. I want to cover in sectors one by one very slowly. The DCF model combined with AI, once I do that, versus a DCF model when I do a financial valuation technique. Can I do a combine of a traditional model and AI and a DCF? Yes. The biggest concept which I understand is I get a slight more accurate and a strong dynamic number crunching in terms of financial forecast other than certain qualitative information, historical information, and real life information. In traditional, what we do in DCF is very simple. I have certain historical data based on certain assumptions. I basically do a normalizing of those adjustments, modify the data wherever I require, come to today's situation. I work on certain growth rate projections, a perpetuity level, possibly through a two-stage, three-stage models, etc., and come to today's value, which is called as discounting these cash flows to present value. All this put together, including a terminal value, for example, if the business doesn't go to perpetuity, or I'm not looking at a valuation from a perpetuity, I'm looking at a specific zone, which means it is as similar as a capital budgeting model where I got something which is called as a terminal value. What is that AI provides me an additional advantage? I'll go through these details individually, but just to summarize it, one is my cash flow predictions can be slightly more accurate. It can be an improved version of what I do in a traditional model based on my thought process, based on the time I approach a valuation. Second, you can do a very strong and dynamic risk assessment. The reason is because you got a lot of flow of information in your basket. You can typically, for a certain risk assessment in a traditional model, we need to go through various websites or go through various government websites to get certain information. When we do our land and building plant and machinery, any of those zones, we need to go back to basic information. And AI helps me to ensure that I can mix a combination of factors. The most important, which according to me, which works in an AI is scenario analysis. This is one thing which I have personally worked and I found it doing wonders for me when I do any valuation. Now, an internal scenario analysis and internal data integration is upon me to what extent I want to take it to. But the AI, the advantage I have is I have a lot of external inputs which are available, which I can plug it onto and I can make it a win-win situation. I will tell you a certain DCF model which I use on a regular basis and how I fine-tune external data integration. Yes, we do valuation. Sometimes we feel that we need automated updates. We do get automated updates. That's a biggest advantage. Once you are sure that an AI is well understood and an answer is taken out of it, and I'm absolutely going back and doing a little of analysis. Please understand my word. I'm just not throwing data. Normally, we believe that, like, if you ask me the current generation, my kids, if they ask me what they do, they just pick up the data, throw the information. If you get information from AI, start going through the data, slightly churning out from the population certain samples where you feel it is relevant, recheck on the data, little analytical on the data will help me in doing a big advantage. And automated updates is something which does wonders in AI, which I cannot work on. It's typically like a stock market. Let's assume I want to know what is today's share price of Coal India. I'll have to go back to the NSE exchange. By the time I look at the exchange, it's already down. I put an AI flow as to how the trend is all about. I will get the entire trend morning from 9 o'clock to today immediately, and possibly also some forecasting, which according to AI may not be correct, but at least I'll get some indicative, some basics about it. Let me go to the first. Let me talk about positives of where AI can work. One is traditional models, we rely a lot on an analyst's judgment. We basically talk about a certain growth rate, we talk about a certain number crunching, and we do a certain valuation process. What we call it as a G, which is called a vitamin G, is called a growth rate. We talk about future revenues, we talk about future expenses, and maybe we may talk about a real options model where in capital expenditure we spent over a certain duration. In the improved cash flow for me, the first master stroke is pattern recognition. You don't, a lot of people do ask, do I need to know R? Do I need to know Python? If you ask me, not necessary. My personal opinion, I may be completely wrong, but the way I have analyzed valuation is use it to the maximum extent you can, possibly without too much of technicalities. The moment you run into technicalities, you get into a completely different phase. Machine learning algorithms basically helps me in talking about certain correlations and basically talks about certain patterns. When historical data I do have, I need to synchronize these data. I have tools available where my synchronization or normalizing adjustments becomes more and more accurate. Whether I need to take a discounting for a certain thing, expenses has to be taken slightly higher because I got a certain benefit. For example, let me tell you, I got an export order in a year. I got an export order of 80 crores, for example. I got 2 years back. Now, normally when you do the normalized adjustments, you knock off those 80 crores of the system because it's only one time. You typically take it out of the system and you work on your historical statement. You do a lot of normalizations when you plug into the numbers. With AI, it gives you certain other advantages, which is qualitative, which helps you in knocking off these and how these costs pertaining to their expenses can knock off, it will give you. Second is called a multivariate analysis. There are tons of variables which impacts our cash flows. The moment you prepare operating flows, financial flows, investing flows, you know you can run it into a macro level or you can run it to a micro level. It is up to you how you want to analyze it. You can talk about macroeconomic indicators. We talk about industry specific metrics and then work out certain analysis. This for me, AI is a very strong tool. Time series forecasting. Very interesting. Let me talk about a startup. Startup works on a concept where one of the concepts which work on is very strong is called a first Chicago. First Chicago talks about optimistic, pessimistic, and four most likely, which is a typical part of PERT CPM which we worked on. Now, first Chicago helps me a lot in startup valuation because it is typically said that the concept of cost approach, market approach, and the other approach, which is called as income approach, doesn't give you a magnified results unless Ashwin Damodaran says that there is a modified cash flow discount model. Yes, it works, actually DCF model. But typically when we talk about time series forecasting, which is one portion, I just mentioned one example. There are tons of examples of this sort. There is something which is called as long short-term memory, which is very strong an algorithm, which is there in LSTM. Now, these basically talks about a certain time frame where you can get certain analysis. Second is called anomaly. I mentioned an exporter of 80 crores. I don't want it to be done system. For example, a COVID crisis taking my sales down and coming it. Normally, I would like to assume that if there was normal sales, I would not ignore the COVID crisis here. We normalize the adjustments. These anomaly detection AI filters out very well, which is called as one-time events, or basically, which there are very skewed projections. AI might provide you much better answers. There's something also which is called as competitive intelligence. When I talk about competitor performance data to understand how the market is moving, I can analyze the growth rates much stronger, where I apply a certain pattern of growth rate. I basically look at the revenue, I look at my return on invested capital. I've got certain parameters like a G9 matrix you could draw. But the competitive intelligence says that you can work out market share shifts, and you can talk about the impact of future cash flows, which is more from a DCF driven model, very strongly. Go to the next one, which is called as risk assessment. We talk about certain concept where if I do a leverage buyout, for example, when I have a leverage buyout, I always have bought a company. Basically, I have an advantage to it, and then I want to go into a certain debt market. Basically, when I buy a company, always the future plan is ready with me. I know when I go to AI, I could work out the real time WACC calculation in terms of debt. What is the current debt market? What is the worst debt percentage provided to me? What is the best interest provided to me? Once you put in a certain AI application, you could get a lot of advantages. So for me, when we work out till perpetuity, because when you acquire a business, normally we acquire with the perception that this business would be a win-win situation. So WACC calculation typically helps me a lot when I put a superset of an AI and run with my numbers. Next is called something which is called as risk factors. Okay, we are talking about certain cost of equity on a CAPM model is fine. And there's something which is called as Genesis Alpha also we use. These are not theoretical, these are practically being used. Now, when you talk about certain company driven risk factors, like now the IT industry is running in a very fast fashion, certain industries are very melted down. Company risk factors are very high for certain things. Now, how do I know when I get a valuation? And let's understand, when a valuation come, you don't have time. Everybody comes this through a fast motion and they say, Murli, I want a valuation to be done ASAP. So you sometimes do not have to work on the company specific risk factors. In AI, when you pump in certain data, based on what you run the data, you might get certain results. I mentioned that back in terms specifically in case of debt. When I talk about company specific risk factor, I'm talking something with related to the equity shareholders. So put together actually is talked about as WACC. We also talk about certain languages which are available where you could talk about risk perceptions. When you only plug in the right question in AI, you will get the right results. Every word which is put in a very generalized manner, which could give you worst results, let me tell you. This is where most of the problems in AI lie. If you ask me the sentiment analysis for a particular corporation, for a particular top line, for a particular sale revenue, will get perfectly detected when I talk about a certain AI process. We talk about something which is called as volatility, which is a main worry where we talk about a range of valuation as per CLD norms, which says that nowadays valuation, you need to give a range, not a specific number, because valuation is subjective. We all know that. So typically, when I want to predict the future volatility more accurately, the historical model, I talk based on purely historical information and I run my path. In AI, the advantage is I can possibly regenerate a path as per their perspective. I might use my perspective. Let me tell you honestly, I don't rely too much on AI because these are all from websites, possibly web related, populated. They may not be right because our thought processes always says that yes, what we are able to justify and what we are able to control, that is why I would like to put it. But always getting another opinion from an AI would be very helpful so that certain errors of mine gets cleared off. A country where there is a lot of macroeconomic variables, AI basically helps you because the dynamism of the country, the growth of the country, the pattern of the country is so heavy that, for example, a company which is an export at dollar fluctuations, what it is going to happen in perpetuity, we really don't know. What is going to happen next 5 years? We absolutely, I can't predict even 1 year what will happen to the dollar.